So now let's bring in our next guest. He's former Ford CEO Mark Fields. He's going to discuss what this morning's data means for the industry. Mark, I'd sort of actually like to get you started there on a point that Phil said doesn't get much attention, and I'm wondering if you can add your perspective about the energy deployed, 12.5 gigawatts. That's the highest on record for Tesla. What does that mean for the industry, and what's your view on that?
Well, obviously, it's a growing part of Tesla's business. And, a lot of this comes down to how much is being generated from the different sectors, whether it's commercial, data center, residential. Obviously, Tesla will give some perspective on that. But overall, I think from a Tesla standpoint, as Phil said, listen, this is a big quarter for them. A lot of it is pulled forward due to the federal incentives going away as of October 1st. And I think what will be interesting, Courtney, is when Elon and Tesla report third quarter earnings, the one thing that's not getting a lot of kind of press right now is the money that they make from the regulatory credits. They sell these regulatory credits to other OEMs so they can remain in compliance with the corporate average fuel economy standards. But with the Trump administration essentially taking the maximum penalty for non-compliance to zero, all those dollars which flow right to the bottom line are going to go to zero. And to put it into perspective, in the first half of this year, they generated a little over $1 billion of these credits, which fell to the bottom line. And their operating profit for the first half of this year was about $1.3 billion. So some challenges ahead for them from a profitability and cash flow standpoint.
Well, really great point. That's not an insignificant number when you put it in those terms, for sure. And you also made the point about perhaps seeing some of this bump in that 497,000 deliveries because of this EV credit change. So do you think that this is just a one-quarter moment, or are we seeing renewed demand for Tesla vehicles that can continue beyond this quarter?
Well, as you saw from what was reported from the other automakers yesterday, all of them experienced significant increases in EVs as people rushed to take advantage of the elimination of the federal incentive. I think in Tesla's case, from an automotive standpoint, amongst other factors, it's more EV competition and the fact that they haven't introduced a new mass market model for since 2020, since the Model Y. And so, from Tesla's standpoint, you got some challenges going forward. But, when you look at the stock price or from a valuation standpoint, Tesla's priced for transformation. But right now they're delivering automotive economics. And a lot of the value of the company, as Phil said earlier, is really betting on robotaxis, AI and robotics. And on robotaxis, listen, they've had full service driving for many years now. So they have over 7 billion miles logged, and that literally dwarfs Waymo. So what really comes down to is the superior data that they have. Can they use that and get regulatory approval? And that could provide a big boost for the company, but they have to get regulatory approval. So it's not just based on technology.
Mark, while we have you, I'd really like to get your take on subprime auto and used cars. We've talked about the Tricolor Chapter 7. There's some charts today looking at CarMax and Carvana and how their books are running hot, in some cases a multiple of prime benchmarks. Is this a canary or not?
Well, they are early indicators into the health of the consumer. As you said, Carl, when you look at used car prices, actually used car prices are probably going to hold up pretty well over the next 6 to 12 months, just for the fact that during COVID, there weren't a lot of vehicles manufactured and sold. And so that, when you think 2-3 years later, particularly for leases, you have less supply coming to the market. So that'll remain artificially high. But yes, when you look at some of these subprime numbers, when you look at some of the failures, like some of the companies that have gone bankrupt, it is a bit of a canary in the coal mine. But I would say, Carl, that I think from the industry right now, there's a lot more tailwinds than there are headwinds going forward, at least over the next 6 to 9 months. You have tax cuts, you have lower interest rates, and you'll have less federal regulation. And I think another thing that's not being kind of highlighted here is with the elimination of the fines for not meeting the CAFE requirements. This is very good news for manufacturers and OEMs like Ford and GM that make big SUVs, a lot of profits on SUVs and trucks, and that's going to be good news in the short to medium term. But clearly, they need to continue to focus on EVs because that's the long-term play here.